Boost Bridge Loan. This is, a product that's been accounting for over 50% of our volume right now, and it's something that I want to share with you guys. So what is Boost used for? It is a short-term 12-month bridge loan that has no payments due. So essentially how that works is that it's a cash out refi, modified interest only. And we're going to use that cash out that we take from that departing property, that equity, and we're going to use that as a down payment onto that purchase, making them actually a non-contingent offerer for that new purchase loan. So extremely valuable in this highly competitive real estate market that we're seeing right now. And I like the way that this graphic kind of breaks down, exactly what this program is. It's taking that small departing property, maybe their humble home they've been living in for 10 years, they've built up equity in, and now they want to use that down payment on their new purchase that is going to be their dream home, something bigger with, more garages and more stories, and something that's going to better support, maybe it's a family that, wants to move into a bigger home because they want to start having kids, right? So essentially it's a program that can help people achieve their dreams of owning their dream home. How does Boost work? So like I said, it's actually two loans in one. The bridge loan on that departing property and on the purchase loan is going to be done with us, and we're going to be that one-stop shop for it. And we're going to pay off any existing liens on that departing property through a cash-out refi up to a 75% loan to value. And like I said, there's no payments due on that. There's just a single balloon payment due once that home is sold. And so when they pay off that interest, no money is coming out of pocket. It's all coming from that sale of real estate. So they're going to be cutting no checks to us. It's just title and escrow is going to handle that whole transaction. So it'll happen behind the scenes, and they won't see it going down. And what's also important to note too is that this bridge payment is not going to be calculated into the DTI on the purchase. So borrowers who are having trouble qualifying for that new purchase loan because other lenders are qualifying them based on their bridge liability, we're not going to count that at all. So they're going to have an easier time qualifying for that purchase loan.
And this isn't the case. I'll interrupt you because this isn't the case that if you're going to do purchase loan.
Yeah. So in this case, we're going to do the purchase loan underwritten to our guidelines, and it's going to be on our.
So you're saying that buyers don't have to use your as a lender to purchase loan because maybe there's a better conditions on the purchase loan, right? This is what you tell me. They don't have to.
Yeah. So the existing bridge product we're speaking about now, the caveat being the only way we're going to give you the equity from a departure property that hasn't sold yet is if we're also simultaneously doing the new purchase loan.
That's my understanding. Now you cleared it.
Yeah.
Because it was confusing. So now it's you basically, like you said, two loans in one. You're pulling out equity up to 75% from existing property, and then you're getting using this for as a down payment to new purchase.
Exactly.
Now talk to me about qualifying. What kind of criteria to qualify?
Yeah, so on that bridge loan, we're basically qualifying borrowers based on the property. So when we're in pre-qual and we're in underwriting, we're mainly looking at the property and seeing if that's something that is going to be enough equity in that house to be able to fully use as a down payment on the purchase. When we income qualify borrowers on the bridge, we're really only just looking at their current employment. There is no income calculation whatsoever. So that's something that can get pre-qualified, pretty quickly. We can write that up in about 30 minutes or so. The qualification comes onto the purchase, in a standard, any other way that you would income qualify a borrower on the purchase. So we can do full doc, we can do 12 to 24 month bank statements, we could do asset qualifier, asset depletion. We could basically use all of our other ATR, ability to repay processes on that purchase loan. So it's going to be, subject to all of our underwriting requirements on that purchase loan.
Okay, sounds good. And the money which is going to be used now, it's because it's internal for you. It's a source of funds, therefore it doesn't matter, and you are not counting any liability on this department residence.
Yeah. So that departure property, we're paying off any existing liens. we're collecting for taxes and insurance. For all intents and purposes, that property truly is free and clear. Nothing is factoring into the DTI calculation.
Yeah,
on
okay,
the primary.
So you're just giving them money to buy new property.
And again, I mean, everything in the non-QM space is based off of FICO and LTV.
Yeah.
So the more money they bring to the table for the down payment on the new purchase, the better the rate is going to be. But it's their money, right? It's the equity they built up in their property. So if they want to use it for other things, paying off personal debt, cover moving expenses, stage the departure property to get the best possible value, that's the borrower's, free will to do what they want with those funds. And, putting some money into staging is probably going to increase the value of that departure. So that might make sense to put some of those cash out funds towards that cost.
Hold on, you brought something interesting. You said that use money, but will they get actual money? Or because you said that money will go towards the down payment?
Yeah, so it depends. So the departure property, we're going to go up to a 75 LTV. Let's just say it's a $1 million property. They have a $250,000 lien. The max we're going to go is 750, right? 75 of the value. We're paying off the existing lien of 250. So then the borrower has 500,000 cash out proceeds.
Okay.
Less fees and costs, right? But that 500,000, he could put all of that to the down payment on the new home, but maybe he's downsizing, right? Doesn't need as much of a down payment. Take 100 grand of that 500 grand, put it towards the down payment, and then use the rest for whatever he wants, paying off debt.
But it's not 500,000 because there is accrued interest.
So no, he's going to get 500,000, right? And then the bridge loan is just accruing interest per day. From the time we fund the bridge loan until that departure property sells, interest is accruing per diem.
And so accrued interest is going to be paid from remaining 25%?
It's going to be coming out of the cash out proceeds when they eventually sell
and that
the
was
house.
from remaining 25%, let's say.
Yeah.
Okay. So now it's the cost of selling and cost of, because they have to pay the real estate agent's commission and you say staging. So will they get this 500,000 in your example as a cash?
Yeah, that's going to be held at escrow. One helpful note is if you can use the same escrow company for both transactions, it is helpful, right? There's multiple loans involved. There's multiple moving parts.
Okay.
But those loans are basically sitting at escrow. We could wire them to the down payment for the new purchase, which escrow will handle, or they could take the proceeds that they want for other purposes.